use it. But now, this week, we have to do another subscription. So, and that is why we are revisiting the class. So, Mr. Sulaiman, you can start to share your screen. I'm going to share. Are you not allowed to share your screen? Check whether you are allowed now. Share them the. Please check if you're allowed now. You can send. Yeah, see if you can share your screen. So you can send the YouTube link to them so that people can start to join. Start Lemon, I can't hear you. Hello.
Hello.
Okay.
Hello. Good
Mr.
evening.
Sulaiman, the tutor I'm asking of the tutor to start the class.
Good evening, sir.
Good evening.
I was unable to join last class, so I'm just entering the class now.
No, I'm not talking to you.
Okay. Hello.
Hello. Good evening, sir.
Hello, sir. I'm still here.
I know you are here. Your tutor has not started. So it's just for you to just exercise patience. It will start. So he's here with you.
Okay.
Just exercise patience.
Okay.
Please, can everyone mute? Thank you.
All right. So I think that's the ending.
So what happened is that your tutor, the network has logged him out. So someone has to leave the call for him to join. So that's the challenge we are facing now. So someone has to leave for him to join. I have told him to be on standby because there will be some quite number of persons waiting to be joined, waiting to join. So he has to be on alert. But I've told him, Sha.
Okay, let me leave so that he can join, sir.
Yeah, you can leave. You may be able to join later, Sha. You can
Okay,
leave
sir.
so that he will be on alert. Yeah, thank you.
All right.
So I think the challenge you're having now is that one person has left and another person has joined who is not the lecturer. So
All right, sir, let him be on standby. I want to leave so that he can join. I'll join through the YouTube. Hello, sir.
The thing is, people will be clicking this joining
To leave, what does
until
it
they
say?
say join. Everybody should leave and log in.
So maybe you should end the class. You can end the class, then all of us will log in.
That's the best solution.
Exactly. I think many people has left now. The lecturer can join. As the lecturer be able to join? Yabi.
I'm in now.
Thank God. It seems like the lecturer has joined now.
Okay, can you hear me? Good evening,
Yes,
Yes, we
we
everyone.
can
can
hear
hear
you,
you.
sir.
Yes, we can hear
Yes,
you.
good evening, sir.
Okay, so we're starting now. Everybody should so we will not be having help. So we want to look at IFRS 2 share-based payment. If you are using two devices, please log out of one and everybody should mute. So this is for the benefit of those that missed the previous one that we held on. I think that should be last week. Was it Saturday or Friday? I think yes. Hello, Baba. Yes, sir. Udu Akubong. Udu, what's happened? You're raising your hand. So let's start. I hope the echo has stopped. That's good. So, like I said, okay, if you have more than one devices connected, please log out of one. That's what is causing this. So I think we can move on now. So IFRS 2 share-based payments. IFRS 2 requires an entity to recognize share-based payment transactions, such as granted shares, share options. What's going on? The equity there. Well, hello?
What happened live stream? Yeah, work. I continue.
But there is echo. Echo anything in channel. Everything is about the look at it.
Show you by join look live stream.
Okay, say YouTube. What go join yẹn lẹ́ẹ̀kan.
No. Ṣe pé ẹ máa echo back. So they join YouTube. So ẹ kàn ṣe báyìí ti join lórí Teams ẹ máa ṣe lọ. Lórí YouTube wọn máa lọ ti ẹ̀ ṣe padà.
Mo ti disconnect yẹn.
Ṣé o ti wá stop láti máa echo?
I hope so.
I continue. I continue.
Okay. So, as I was saying, IFRS 2 requires an entity to recognize share-based payment transactions, such as granted shares, share options, or share appreciation rights. So, let me give you a background as for what this standard is all about. This is a standard that is very technical, I won't say, because it's a regular way through which, let's say, a well-structured entity operates with when it comes to how they reward their employees, most of the time, it's usually are connected with the settlements or the reward the company wants to accord their employees and even some of their directors sometimes. So, and when we say share-based payments, it's a way of trying to settle an obligation between an entity and those that the entity is involved with a value that is calculated using the share value of the company. So we get to understand that better. So, but it's very, very important because it's very crucial to a well standardized entity to usually use this. So, and I think in recent time, it's one of the areas I can usually interested into. So let me give that short background. I hope some of you were at the last class to where we take the same standard. It's because of those that missed it that we're having this discussion. So IFRS 2 requires an entity to recognize share-based payment transactions, such as granted shares, share options. So when we say granted shares, it's not here. I must also clear the hair on this that when we say share-based payment, it's not synonymous with the normal shares that are recognized in your equity. No, it's not synonymous with a company decide to increase the number of shares they have by going for IPO, initial public offering, or they want to increase the number of shares based on the authorized shares available, increase the issued shares. No, this is actually when it comes to like a settlement, either between the company and the employees, including the directors, or those that they have obligations with, like suppliers and so on and so forth like that. So please get this background very well. It is very, very important that you don't mix it up. So then how it is measured, we explain as we move on that. So including transactions with employees or other parties to be settled in cash, other assets or equity instrument of the entity. All of this will still be calculated based on what the share of the company is at that period of time. So specific requirements are included for equity settled and cash settled share-based payment transactions, as well as those where the entity or supplier has a choice of cash or equity instruments. IFRS 2 was originally issued in February 2004 and first applied to annual periods beginning on or after 1 January 2005. Before I move on, I want to say generally that when you are answering questions on standards, it is very important that you approach it, making sure that there are 4 things you recognize that you touch. Irrespective of whether the question does not even ask you for theoretical explanation or not. Irrespective of, okay, they just gave you a question they want you to solve, but you know they're asking about a particular standard. Please give them this background, but it depends on what the question says that we tell how deep you're going to go in your writing. So firstly, you need to give them a background like we just did now. Tell us about what the standard is all about. Let us introduce us to the standard. So give us an introduction to the standard. If the question is directly on theoretical basis of that standard, then you can go on to state the historical perspective of how the standard was developed, when, how long did it take them, what are the stages involved. So all of that you can mention, as you can see. I'm not going to go through this because of time. So you can see it's much, so you may not need to go through them, but it's for you to understand some basics, how they come by when it comes to that standard. So what is the summary of this standard? What does it entail? Special edition of, okay, so you find the, definition of share-based payments. A share-based payment is a transaction in which the entity receives goods or services either as consideration for its equity instrument or by incurring liabilities for amount based on the price of the entity's shares or other equity instrument of the entity. The accounting requirement for the share-based payment depend on how the transaction will be settled, that is, by the issuance of equity, cash, or equity or cash. So I was saying the other time that I'm going to explain when we get to where. So, like I mentioned, there are 4 things you should touch if it's a theoretical based question, and if it's not, if you could see that, oh, the answer allotted to that question is much, most especially, so you need to touch based on the theoretical foundation or theoretical aspect of these standards. So, one, I mentioned the foundation, the introduction, give them the background of that standard. The second thing you need to do is a theoretical breakdown, the definition of that standard, the scope of that standard, the measurement of that standard, the measurement recognition criteria of that standard. So they are almost like 5 now, but your definition and introduction can be merged. But there is scope, there is measurement, there is recognition. So please, all of these are very important, which you need to actually pay attention to. So for this standard, the definition is that it's a transaction in which the entity receives goods or service. You can see. You know, when you sell share, you only receive cash. Okay, so, but here we're talking about the exchange of goods or service, either as consideration for its equity instruments or by incurring liabilities for amount based on the price of the entity's shares. Like I told you earlier, it's just like finding a common a value for that particular exchange, but you're now calculating that value on the basis of the share of the company. So that's what they're trying to say here. Or the equity instrument of the entity. The accounting requirement for the share-based payment depends on how the transaction will be settled. That is by the issuance of equity, cash, or equity or cash. So dependent. That should be noted. Then we move on to the scope. What areas does the standard cover? Which area does it exclude? It is very important we know. So the scope. This concept of share-based payment is broader than employee share options. You know, I mentioned that already. I mentioned that it will even involve the directors and suppliers and what have you like that. So, IFRS 2 encompasses the issuance of shares or right to shares in return for services and goods. Example of items included in the scope of IFRS 2 are share appreciation rights, employee share purchase plans, employee share ownership plans, share option plans, and plans where the issuance of share or rights to share may depend on market or non-market related conditions. So this, if you are happy to talk about the scope, you may just touch base on this particular thing I just read out now. So in a summary way, like summarize that, what are the areas that this standard covers? It also applies to all entities. There is no exemption for private or smaller entities. Furthermore, subsidiaries using their parent fellow subsidiary equity as consideration for goods or services are within the scope of the standard. Insofar is not a direct issuance of shares. So there are 2 exemptions to the general scope. So please pay attention to this more. When you're dealing with IFRS 3, so there are some portion which is business combinations. There are some portion of it that does not fall within the scope of IFRS and IFRS 2. So, secondly, IFRS 2 does not address share-based payment within the scope of paragraph 8 to 10 of IFRS 32. You know, IFRS 32, IFRS 9, IFRS 7, and IFRS 39. They are all related to financial instruments. So, all of these 2, just only IAS 32 and IAS 39 that are not covered within this standard. We should note that. Also, IFRS 2 does not apply to share-based payment transactions other than for the acquisition of goods and services. So you need to pay attention to that. So if there are share-based payments that do not relate to goods and services, then IFRS 2 does not have anything to do with them. Share dividends The purchase of treasury shares and the issuance of additional shares are therefore outside of the scope of this standard. Then I told you earlier, recognition and measurement. Issuance of shares or rights to shares requires an increase in a component of equity. IFRS 2 requires, I think we should pay attention to that first statement. Issuance of shares or right to shares requires an increase in the component of equity. IFRS 2 requires the offsetting debit entry to be expensed when the payment for goods or services does not represent an asset. You can see that. So when it is that you want to pay for goods or services, but that payment does not bring in an asset, then you usually opt for IFRS 2 to measure that and recognize the exchange. The expense should be recognized as the goods or services are consumed. So when the goods and services has been fully consumed, the expense is fully exhausted. For example, issuance of shares or rights to shares to purchase inventory will be presented as an increase in inventory and will be expensed only once the inventory is sold or impaired. The issuance of fully vested shares or rights to shares is presumed to relate to past service, requiring the full amount of the grant date fair value to be expensed immediately. So I think we are getting there now. How do you measure share-based payments? So the issuance of fully vested shares or right to shares is presumed to relate to past service, requiring the full amount of the grant date fair value to be expensed immediately. So that means the grant date fair value is what you use to measure share-based payments. If it is vested, that vesting period, I hope I will explain this better. Issuance of shares to employees with, say, a 3-year vesting period. Vesting period is the period in which the service is expected to lapse before we can now conclude that the expected service has been achieved. Then the employee is entitled to receive that shares. So that's what this is all about. That within that period, we can now recognize the service and the employee is due to receive the share-based value of that service. Therefore, the fair value of the share-based payment determined at the grant they should be expensed over the vesting period. So you are not going to go and be posting it in the equity, rather you expense it as if an expense. As a general principle, the total expense related to equity settled share-based payment will equal the multiple of the total instrument that vests and the granted share value of those instruments. In short, there is truing up to reflect what happens during the vesting period. However, if the equity settled share-based payment has a market-related performance condition, the expense will still be recognized if all other vesting conditions are met. Following example provides an illustration of a typical equity settled share-based payment. Please, let's pay attention to this and let's use this to understand how it is being done. Company grants a total of 100 shares options to 10 members of its executive management team, 10 options each on 1 January 2025. These options vest at the end of a 3-year period. Before they could be entitled to these shares, then 3 years must have lapsed. The company has determined that each option.
Your screen is not showing, sir.
Any other person to confirm that, because at my end, my screen is still showing me.
Oh, we can't see
Yes,
anything.
sir. Yes,
No, your
sir.
screen is not
That's
showing.
it. We can't
We
It's
can't
not
see anything
showing.
actually.
That's your speaker.
Not showing.
It's not showing since we started.
It's not showing, sir.
It's not showing even right from the beginning of
Nothing showed till you started.
How about now?
Yes, it shows.
It's showing now.
Yes, sir.
Yes,
When
it's
are
showing.
not
showing.
Okay.
Where was I when you last see the screen?
In short, since she started class, she will not see.
We didn't see you started. Nothing has shown.
From the start.
I can't get it. What do you say?
She started the class, we were not
From the
seeing this.
beginning.
It
You
didn't show
said?
from the start. From the start, it didn't show.
And you lack of complaint now.
Only a picture we have been seeing.
We're sending messages.
Sir, we've been
Check
sending
anything.
messages,
You know
even
I'm
on
not
YouTube. On YouTube.
I'm not on YouTube directly like that, so
Oh.
I was just focusing on this time.
Even here, sir, we sent
On Google
messages,
Meet,
sir.
we were sent messages.
Not even check anything. I'm so sorry about that. I was focusing on the screen, and it's still reflecting that it's showing here. You might need to go back. So can we start from the definition?
No, let's
Yes,
continue.
please. Yes, please. Please start from beginning because I
I think
didn't
we
see
should
any
just continue, sir.
definition.
Let's just continue.
Let's continue.
Please
Please
continue from
continue.
We are all
from
going to
the
get this
illustration,
summarized
please.
notes.
Yes, definitely. You have to note. I even shared it already for those that attended the last one. But I think you guys are all on the group now, so you have access to it. So these options first at the end of a 3-year period. The company has determined that each option has a fair value at the date of grant equal to 15. So please pay attention to this. Or at the grant date, the value of that share base is 15. The company expects that all 100 options will vest and therefore records the following entry at 30 June 2085. That's 6 months after the introduction or the issuing of this share-based instrument. So we need to pay attention to how they really got the value they are calculating with. So we have 10 members of the executive management, and each of them has 10 options each. So that's how they arrive at 100. But the value of these options is 15, according to what we just said at the grant date is 15. So 100 times 15. Then the total number of periods is meant to be is 3 years. But for now, we break it down to months. So we now have 6 months gone already. So that's why we have 250. 100 times 15 is 1,005. Divided by 6, you got 250 from there. So this particular point is very, very important. We get the gist on how they calculate this and the right dates to choose. So if all 100 shares vest, the above entry will be made. That is, you're going to debit the share option expense. You can see expense, and you credit equity. At the end of each 6-month reporting period, that is every 6 months, this is the way you recognize it. So if one member of the executive management team leaves during the second half of 20x6, which year did we start?
January 1, 20x5.
Yes, so at the beginning of 20x5. So, and we could see that our period is 6 months. So the first 6 months is June of 20x5. So if they now said that if
Sir, can you please explain that statement?
Leaves during the second half will be what? July to December of 20x6. So please get that background rightly. So that means we will have the first 6 months, the second 6 months, the third 6 months. Do we understand now? So we are in the fourth 6 months. Do you get that?
No, sir.
Sir, that statement that have interim something. Can you explain this?
Okay, I said they have confirmed to us that since they mentioned that the vesting period will be considered at every six months. So that is our period we'll be dealing with. Do you understand this first statement now?
Okay. Yes, sir. It's good.
Others alpha.
So that means we'll be computing it over 6 each year.
So I don't understand. I don't
Just listen, just
I
listen.
don't
I've
understand.
not done anything.
Sorry,
That's
I didn't
I
understand.
don't understand.
If it
I'm
was the
understanding you,
first
sir.
question you don't understand, is it from here
Sir,
you don't
are you
understand?
saying we'll be computing it for
No
six
worry,
months for
no worry,
year?
no worry. Is it from here you don't
Sir,
understand?
go through the explanation again from the beginning, sir. Don't be offended, sir.
Please explain the
This
question, sir.
question, right? Because I don't think I want to
Yes,
go
sir. The
back
question.
to the okay.
The question, sir.
That's the question, sir.
Okay. The company grants a total of 100 share options to 10 members of its executive management team. 10 options each, which also equals back to 100. If each of them take 10 and they are 10 in number, 10 times 10 is 100. You get that one on 1st January 20x5. Should we move on?
Yes.
Yes, sir.
Yes, sir. Yes,
This
sir.
option vests at the end of the 3-year period. Vesting period implies the service period. The employees are involved. We want to see whether they will still be with the company till the end of that period. So that's what they are trying to say, that these options first, that is, they will be entitled to this option at the end of 3-year period. Is that clear?
Yes, sir. Go on.
The company has determined that each option has a fair value at the date of grant equal to 15. They have mentioned to us when they are explaining how we go about the share-based payments that the grant date is the share value at the grant date is the one we are going to pay attention to. So that's what they are trying to imply here. So the grant date value is 15, according to them. So the company expects that all 100 options will vest and therefore records the following entry as 30 June 20x5. That is the periodical arrangement that we have. That means six months. Because in the question given to us, the period they considered is 6 months. So we now break down 3 years into six months. So how many 6 months do we have in 3 years? Somebody.
6.
But why are we breaking down to 6 months in a year?
We are using 6 because they said, therefore, records the following entry at 30 June 20x5. So they have given us that guidance that we are going to use 6 months. Do you understand that?
Yes, sir.
Some people do not go with us. This is very clear. I don't know. I don't expect this to become confusing.
Understood up to that point, sir.
Okay, thank you. So, how did they get 250? That is the basis you need to pay attention to. Now, we have confirmed where we got 100 from, right? 100 is 10 people, 10 options each. 10 times 10, 100. Right?
Sure.
That's fine, sir. That's fine.
Yes, sir. Yes, sir.
Okay. You said?
Go ahead, sir.
Fine, guys. Go ahead.
Okay. Then we are given the value at the grant date, which is 15. So 100 options multiplied by the value at the grant date, which is 15. That's 100 times 15. Okay? Then the period we are considering has been given to be 6 months. So for each of our accounting, we'll be considering 6 months. So that's how, when they got 1.5, they now divided it by 6 to get 250. I think that That is clear at this point, right?
Yes.
Yes, sir.
Yes.
Yes, sir.
But we
Now,
didn't take
listen to the
consideration
explanation
gen member.
posting. Okay, let me now talk about the posting. You know, we said it's going to be expensed. Expensing means that which of the final accounts will it appear? When you expense something, where will you post it?
Financial performance.
P&L.
Profit or loss.
POL. POL.
POL. I debit POL.
Pure.
So you debit your share option expense and you credit your equity. So your equity will be in your statement of financial position. Okay. So if all 100 shares vest, the above entry will be made at the end of each 6 months. Please pay attention to that reporting period. However, they just created a scenario out of that now. If one member of the executive management team leaves during the second half of 20x6, I think that's where we got to that. Some people did not go along with us again. So that 20x6 now, I now wanted us to analyze it. How did they, what period did it fall into? We have 6 months end in June 20x5, right?
Mm-hmm.
The second 6 months we had in December 20x5. That's the second one. No. The third period we end in June 20x6. Are we together? And that will be the first half of 20x6. Now, in this case, they said the second half of 20x6, that is the fourth period. Do you get it?
Yes.
So, therefore, forfeiting the entire amount of 10 options, the following entry at 31 December 20x6. Before you look at the posting, check the calculation first. So if one person opts out and he has 10 options, that means 10 out of 100 is gone. Is that right?
Yes.
Some people are not responding.
Yes.
Yes, right.
Okay, so we are left with 90. 90 times 15 divided by 6. You know, we are considering 6 period. Remember, that one is clear. Okay. So that's going to give us 225 per period. That is from that point onward, we now have how many periods to consider?
4 periods.
3 more periods.
4 periods.
4 periods.
So that's where they got from 225 times 4 minus 3 periods has been taken away. Remember now, 225 times 4 will give us 1,000. Is it 1,000? No, it's 900. Right? Nobody is responding. No.
We are following you, sir.
People 900.
100.
Right?
Yes, sir.
There's a question, sir.
It's going to give you 750. So if you take away 750 from 900, you are now left with 150. That's how they got the 150. I want to move on because of time. Shall we?
Question, sir.
So depending on the type of yes. You said?
Please, sir, how do we arrive at the 250?
You know, they said the first period, June 20x5 is gone. Second period, December 20x5 is gone. Third period, June 20x is also gone. The person opted out in the second half of 20x, which is the period from July to December of 20x.
Okay. Okay, sir.
Okay. So, measurement guidance, depending on the type of share-based payment, fair value may be determined by the value of the shares or rights to shares given up, or by the value of the goods or services received. First one, general fair value measurement principle. In principle, transactions in which goods or services are received as consideration for equity instruments of the entity should be measured at the fair value of the goods or services received. Only the fair value of the goods or services received cannot be measured reliably with the fair value of the equity instrument granted be used. These are principles. And if you happen to have a theoretical question to talk about IFRS 2, these are the things you need to master and present. So measuring employee share options, if it is employee share options, there is no two way about it. You're going to use equity instrument granted. So we move on. When to measure fair value options. For transactions measured at the fair value of the equity instrument granted, such as transaction with employees, fair value should be estimated at grant dates. At grant dates, please note it. At grant date. In the exam, they create a scenario, they give you issue date, they give you vesting dates, they give you grant dates. So know the exact dates you are going to consider and the value attached to it. So when to measure fair value goods and services, for transactions measured at the fair value of the goods or services received, fair value should be estimated at the date of receipt of those goods or services. So that one you don't need to wait for the vesting period. No, once you receive the goods or service, you can measure how much was the fair value of what you got. So measurement guidance for goods and services measured by reference to the fair value of the equity instrument granted. IFRS 2 specifies that, in general, vesting conditions are not taken into account when estimating the fair value of shares or options at the relevant measurement dates as specified above. Let me explain this part. When it comes to goods or services measured by reference to the fair value of the equity instrument granted, you are not going to consider the vesting period. Do you understand? If it is goods and service measured by reference to the fair value of the equity instrument, so once it is equity we are dealing with, you don't need to consider the issue of vesting period. Instead, vesting conditions are taken into account by adjusting the number of equity instruments included in the measurement of the transaction amount, so that ultimately the amount recognized for goods or services received as consideration for the equity instrument granted is based on the number of equity instruments that eventually vest. So this may be somehow tricky, but just understand the baseline, and that's the fact that you are dealing with this because you want to actually recognize the value you are considering. In paying attention or in line with what your equity value is at that period. So that's what this is all about. More measurement guidance. IFRS 2 requires
Mr. Sulaiman.
Yes.
Sorry, can you zoom out your screen for the advantage of those people joining on YouTube, so they could not see the screen properly? So just zoom it out so that it can be more bold. Yes, it's very faint.
Okay. Let me see. I don't know whether it's better now. Oh, I'm coming.
It's not better. It's still the same. So this is what you would do. Go to that plus up.
I'm trying to do that.
You have ask copilots. Can you look at the hub, the pens by that top side? You will see plus, you will see minus. Have you seen it?
I'm coming. I've not seen any plus minus here.
It's right on the top. Okay, you can continue. You just
Where
manage
the
that.
6 of 6 is.
Where it is showing the number of pages.
Exactly.
Can you see
Okay.
it?
Okay. I'm coming.
You can see plus there. So just click on the plus. It will zoom out. Yeah,
How about
it's okay like that. No, it's too it's too
this one is not
you
too
can
much,
reduce
Abi?
it. Yeah, so reduce it by the minus.
I think it's okay like this.
Yeah, so you will now have to drag it to the left. Yes, it's okay like this.
And everything is balanced now.
Oh yeah, continue.
So where were we? Okay, I think we're on more measurement guidance. So if IFRS 2 requires the fair value of equity instruments granted to be based on market prices, if available, and to take into account the terms and conditions upon which those equity instruments were granted. So when we talk about market prices, it's the fair value. Fair value and market prices are the same thing. Like this, what price is that particular item exchanged for at that particular time at the markets? So, or the arm's length measurements, all of that. So that can be more understood when we consider IFRS 13, which is fair value. So, in the absence of market prices, fair value is estimated using a valuation technique to estimate what the price of those equity instruments would have been on the measurement date in an arm's length transaction between non-eligible willing parties. The standard does not specify which particular model should be used. If fair value cannot be reliably measured, IFRS 2 requires the share-based payment transaction to be measured at fair value for both listed and unlisted entities. IFRS 2 permits the use of intrinsic value, that is fair value of the shares less exercise price. In those rare cases in which the fair value of the equity instrument cannot be reliably measured. However, this is not simply measured at the date of grants. An entity will have to measure intrinsic value at each reporting date until final settlement. What is the performance condition? IFRS 2 makes a distinction between the handling of market-based performance conditions from non-market performance conditions. Market conditions are those related to the market price of an entity's equity, such as achieving a specified share price or a specified target based on a comparison of the entity's share price with an index of share prices of other entities. So what they are talking about here is market conditions has to do with how the market price of an equity is determined. Because before there is for every listed entity, there is a price at which their shares are exchanged in the stock markets. So this is what this is actually explaining. So before we determine that that's the price with which we want to recognize that share-based payments, you need to consider what the market price of that entity is at that period of time, or the index of share prices when they are not listed. Some companies are not listed, but similar companies that are already listed can be used as a base for you to arrive at what price you want to consider. So market-based performance conditions are included in the grant date fair value measurements. Similarly, you need to pay attention to this. Non-vesting conditions are taken into account in the measurement, not the vesting condition. Rather, the non-vesting condition, that is, you don't need to, remember we have mentioned something related to this before. You don't need to wait for the service period has to lapse. No. Rather, when the goods has been exchanged or service has been delivered, not that kind of service we mentioned the other time. So, not those that are within the company's employment, rather those outside it. That's what this is telling us. However, the fair value of the equity instrument is not adjusted to take into consideration non-market-based performance figures. These are instead taken into account by adjusting the number of equity instruments included in the measurement of the share-based payment transaction and are adjusted each period until such time as the equity instrument vests. That's the end of our presentation today. So if you have questions, you have the floor. Let me check and see if there are hands up.
Good evening, sir. Good evening, sir. Yeah. Share-based payment is concerned. Is this all about share-based payment, sir?
Theoretically, but when it comes to the exam, I can usually mix standards sometimes, and this is one of the standards they usually want to mix. Like they will mix it up with another standard. So for what we have seen, I think they like to mix share base with fair value itself. They also like to mix it with I forgot the another standard they used to mix. So they usually want to mix it up. So you need to now understand the two standards differently, then how it is going to be matched. So
All right, thank you. And also, the last time you shared the material on the group, this was not the material that was shared. I can't pick
okay,
this
I
up.
can share this one.
All right, thank you very much.
Sir,
Okay.
thanks for the lecture. But I would like to know if you take some ICANN past questions based on this topic, and maybe you can explain one or two, or you explain one, we go and do one and then submit to you, just to have a better understanding of the standard.
Oh, I'm sorry, that may not happen tonight because even taking you is a risk on my part. I have exam, and like I have exam on Monday, and from Monday till now till tomorrow till Saturday, I'm doing assignments. Like so, I'm just in fact I just have to squeeze out time to just attend to you guys tonight. Next week I will not even be available at all. So I may not be able to do that. I just want to try and make up for those that were unable to do it last. Some
Hello,
other
sir.
time.
Good evening, sir. Hello, sir.
Yes, good evening.
Yes, sir. For the calculation that you did on the IFRS 2, I observe you mentioned different type of what's it called? That we have equity share base, we have is it cash share base? Is it this calculation that is applicable to all the types?
No, it depends. It depends. This one we did is directly when it comes to equity based, like the exchange is on equity. If it is share, you know what they mentioned there is that it's going to be calculated. You just need to know what the value of the equity of the company is as at that time. To calculate what the cash exchange will be. But in the long run too, they are still going to exchange for cash if it is cash based. But there are some that has to be mixed. They will pay part of the money as cash, the other one will be paid as equity. But the baseline is that they are calculating the value, what they want to exchange based on the value of the company's shares.
All right, sir.
So my question is still on the calculation aspect. We did not take into consideration the 10 members that are vesting at the vesting that are granted the vest at the vesting date. We didn't, in as much as nobody left as at the first period. So I don't know why we didn't take consideration of those 10 members. That's one. And then two,
Wait, before you go to two, because I may forget. Wait, you said for the first part, right?
Yes, sir. The 10 members that have shares.
Okay.
So, but we didn't take 10 of them into consideration because none left as at the end of
10
the
of
first
them now.
period.
That's why we are having 100 here. It is 10 members, 10 options, 10 times 10. We now have 100.
Is it 10 times 10 or 10 times 100?
No,
The shares is 100.
no. Listen, they said the company grants a total of 100 share options to 10 members.
Exactly.
If you want to distribute 100 for 10 people, how much will each of them has?
10.
That's it now. The actual shares they gave out is 100, but it is allocated to 10 people. So for that reason, it is 100 divided by 10, which gives us 10. Then with that 10 times 10, that's why they even put it here that 10 options each. So they took into consideration all of 10. That was why they now said that, okay, let's assume one of them is leaving by this period. Then if you take away just one person, that person is going with 10 options. That's why we are now left with 90. Is it clear now?
Okay. Yes, it is. Thank you, sir.
Okay. Next.
Sir,
Okay, sir.
please, can you go option?
One word, we cannot hear you.
Can you go over the adjustment after this?
I can't hear you. I don't know whether it's only me.
She's saying that you should go over the calculation again, especially the second part after one director left.
Okay, let me go over that again. Okay, so here it is assumed that one person left at the second half of 2026. This means that the person was with them for the first 3 periods. Each of the periods is 6 months, right?
Yes.
So that's why, because the person has left for the period we are now considering, which is the 4th period, which is ending in 31 December 2026. We now have one person left with 10 options, which is 10 out of 100. We now have 90. Multiplied by the value at the grant date, which does not change, which is 15. Divided by 6 periods, which is still from July to December, which is 6 months. That's why we say have 6 periods. They got 225. Do you understand it to that level?
Yes.
Okay. So the remaining periods we want to consider now is from before that person left. Before that person left, that's the 3rd period. 3rd, 4th, 5th, 6th. That's why they say have multiplied by 4. You understand that one?
Excuse me, sir.
Please order should mute so that we can hear you.
The question here is that the 4th period, there are 3 periods where the directors were 10, and that is 4th, 2nd, and 3rd period.
Yes.
And it's supposed to be a 3 years option. Now, the 4th period, the 5th and 6th are supposed to be considered, but we are having 4. Why are we having 4 instead of 3 remaining periods?
Yeah, that's what I want to explain. So those 3 periods that have gone by is why they removed 250, 250, 250 from the total they got. So that what they are now left with, as at that time, is just the 1 period, which is the last period, which is ending in 31st December 2026. The 2 years is 4 periods, right? Don't consider it for the rest of the period remaining. start from the beginning. In 2 years is 4 periods, right? Yes or no?
Yes.
Okay, we have to consider it on yearly basis now and no longer on periods basis.
Wait. So the person started with them, and the person was with them for 4 periods. Only that he left at the fourth period, right?
Yes.
So that is what they did initially. 225 times 4. That is that. Is that clear now?
Clear.
Okay. So the 3 periods before that fourth period, he was fully with them. So we don't want to consider what happens there.
Okay, understood. Yes.
So that is why they removed that. We now be left with the portion of the fact that we are dealing with 90 people, 90 options instead of 100 now. When we take that away from the total, we get that's how they got that 150. Okay, I think nobody is raising up hand again. So
Okay,
that
thank you, Mr. Suleiman. Let's clap for him. Let's clap for him. Clap for him. Clap for him. Use the emoji. Clap for him. Clap for him. Has done well. Apologies for the technical glitch we had at the beginning of the class. It is Nigeria that happened to our network, right? But at least we were still able to make it a class, right? So it is a makeup class for share based, and the reason why we have to appreciate him more is because he's not chanced. He is undergoing examination, and yet he's taking us time for the sake of humanity to do this for us. We appreciate you so much. May Allah reward you and grant you grant you more knowledge and understanding and shifa. So we as for from today on, so this class is clashing with one of other classes in skills level. So we'll be using these other accounts. So for those of you that that joined here, you can also subscribe on this. So each time we start, you can receive notification that the classes are started. But what we'll just maintain is that we'll maintain a singular account for most of all our videos, so that you guys can have access to them in a singular place. Right? That's what we'll just do. So may Allah assist us. Thank you so much. Enjoy the rest of your night, and then good night. Thank you. Good night.
Good night, everyone.
Good night.
Bye.
Thank you.
Good night, sir. Good night.
Thank
Good
you.
night.
God bless
Good night.
you.
Thank you.
Good night.
Night.